This is Module 3. Money and Functions. Economists define money as any good that is widely accepted as final payment for goods and services. Money, no matter the form, such as cowrie shells in Africa, or strings of beads called wampum used by Native Americans and early American settlers, or coins and paper money, all have three functions. 1. Money is a store of value. If I work today and earn $25, I can hold on to the money before I spend it because it will hold its value until tomorrow, next week, or even next year. 2. Money is a unit of account. You can think of money as a yardstick, the device used to measure value in economic transactions. 3. Money is a medium of exchange. This means that money is widely accepted as a method of payment. Money operates as a common means of exchange. If one had to barter for everything, it would be difficult for a poet to barter for a new transmission for their car. It would be difficult for a person to find someone who had goods you desired for what you could offer in return. Money reduces the cost of transactions. Examples of commodity money are gold and silver coins. Gold coins were valuable because they could be used in exchange for other goods or services, but also because the gold itself was valued and had other uses. Commodity money gave way to the next stage, representative money. Representative money is a certificate or token that can be exchanged for the underlying commodity. For example, instead of carrying the gold commodity money with you, the gold might have been kept in a bank vault, and you might carry a paper certificate that represents or was backed by the gold in the vault. It was understood that the certificate could be redeemed for gold at any time. Also, the certificate was easier and safer to carry than the actual gold. Over time, people grew to trust the paper certificates as much as the gold. Representative money led to the use of fiat money, the type used in modern economies today. Fiat money is money that does not have intrinsic value and does not represent an asset in a vault somewhere. Its value comes from being declared legal tender, an acceptable form of payment, by the government of the issuing country. In this case, we accept the value of the money because the government says it has value and other people value it enough to accept it as payment. The economic functions of banks. The primary role of banks is to take in funds, called deposits, and pool them. They then lend them to those who need funds. Banks are intermediaries between depositors, who lend money to the bank, and borrowers, to whom the bank lends money. The amount banks pay for deposits and the income they receive on their loans are both called interest. Depositors can be individuals and households, financial and non-financial firms, or national and local governments. Making loans. The bank converts shorter-term deposits to make longer-term loans. This converts a liability, such as interest paid to depositors, to an asset, loans made to borrowers. The bank charges a higher rate on the loans than they pay for the deposits. The difference is the bank's profits. Banks can complement traditional deposits as a source of funding by directly borrowing in the money and capital markets. They can issue securities, such as commercial paper or bonds, or they can temporarily lend securities they already own to other institutions for cash. Banks can also package the loans they have on their books into a security and sell this to the market in a process called securitization. Transmitting monetary policy. Fiscal policy involves the use of tax and spending policies by the government. The Laffer curve is the relationship between tax rates and tax revenue. The government uses banks to express its monetary policy by increasing or decreasing the reserve requirements of the banks. The Federal Reserve Bank does not participate directly in formulating U.S. fiscal policy. The Federal Reserve System are responsible for the conduct of monetary policy. If the government wants to have more money in circulation, it lowers the amount of cash reserves the banks are required to have on hand. This allows the bank to lend more money. If inflation is a concern, then the government will raise the reserve requirement to reduce the amount of money available for spending. A sharp increase in bank reserves or liquid assets can lead to a credit crunch by reducing the amount of money banks have to lend, which can lead to higher borrowing costs as customers pay more for scarcer bank funds. A credit crunch can hurt economic growth. As was seen in the 2023 failure of Silicon Valley banks, banks' vulnerabilities arise primarily from three sources. 1. A high proportion of short-term funding, such as checking accounts and repos to total deposits. Most deposits are used to finance longer-term loans, which are hard to convert into cash quickly. 2. A low ratio of cash to assets. And 3. A low ratio of capital, assets minus liabilities, to assets. SVB was required to hold on to bonds they had purchased until maturity. When the Federal Reserve raised rates, the bonds were yielding less than the cost to borrow. In simple terms, their liabilities were greater than their assets. When the bank announced that it needed to raise money to pay depositors and creditors, it triggered a run on the bank. Depositors withdrew their money, further reducing the bank's ability to remain solvent. During such a run on deposits, a bank may have to sell other longer-term and less liquid assets, often at a loss, to meet the withdrawal demands. If losses are sufficiently large, they may exceed the capital a bank maintains and drive it into insolvency. The structure and functions of the Federal Reserve System. The Federal Reserve System performs 5 general functions to promote the effective operation of the U.S. economy and, more generally, the public interest. 1. The Federal Reserve conducts the nation's monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates in the U.S. economy. 2. Promotes the stability of the financial system and seeks to minimize and contain systemic risks through active monitoring and engagement in the U.S. and abroad. 3. Promotes the safety and soundness of individual financial institutions and monitors their impact on the financial system as a whole. 4. Fosters payment and settlement system safety and efficiency through services to the banking industry and the U.S. government that facilitate U.S. dollar transactions and payments. 5. Promotes consumer protection and community development through consumer-focused supervision and examination, research and analysis of emerging consumer issues and trends, community economic development activities, and the administration of consumer laws and regulations. In establishing the Federal Reserve System, the United States was divided geographically into 12 districts, each with a separately incorporated reserve bank. As the nation's economy became more integrated and more complex through advances in technology, communications, transportation, and financial services, the effective conduct of monetary policy began to require increased collaboration and coordination throughout the system. There are 3 key entities in the Federal Reserve System: the Board of Governors, the Federal Reserve Banks, and the Federal Open Market Committee, FOMC. The Board of Governors, an agency of the federal government that reports to and is directly accountable to Congress, provides general guidance for the system and oversees the 12 reserve banks. 2 other groups play important roles in the Federal Reserve System's core functions. 1. Depository institutions, banks, thrifts, and credit unions. And 2. Federal Reserve System advisory committees, which make recommendations to the Board of Governors and to the reserve banks regarding the system's responsibilities. How the banking system creates money. Banks are required to keep a reserve of cash and other liquid assets on deposit with the U.S. Federal Reserve. Banks create money when they lend the rest of the money depositors give them. This money can be used to purchase goods and services and can find its way back into the banking system as a deposit in another bank, which then can lend a fraction of it. The process of relending can repeat itself a number of times in a phenomenon called the multiplier effect. The size of the multiplier, the amount of money created from an initial deposit, depends on the amount of money banks must keep on reserve. Banks have several ways of making money, besides pocketing the difference between the interest they pay on deposits and borrowed money and the interest they collect from borrowers or securities they hold. They can earn money from 1. Income from securities they trade, and 2. Fees for customer services, such as checking accounts, financial and investment banking, loan servicing, and the origination, distribution, and sale of other financial products, such as insurance and mutual funds. Banks earn on average between 1 and 2% of their assets, loans, and securities. This is commonly referred to as a bank's return on assets. The Federal Reserve creates money by changing the target Fed funds rate with the goal of affecting other interest rates, or it may buy Treasury securities on the open market to add funds to the bank reserves. Banks create money by lending excess reserves to consumers and businesses. This in turn ultimately adds more money in circulation as funds are deposited and loaned again. What determines the quantity of money and the nominal interest rate? The nominal interest rate is the rate of interest before adjusting for inflation. This is how money supply and money demand come together to determine nominal interest rates in an economy. Like many economic variables in a reasonably free market economy, interest rates are determined by the forces of supply and demand. Specifically, nominal interest rates, which is the monetary return on savings, is determined by the supply and demand of money in the economy. The supply of money is set at the discretion of the Federal Reserve. The Fed may choose to alter the money supply because it wants to change the nominal interest rate. The Fed generally controls the supply of money by open market operations where it buys and sells government bonds. When it buys bonds, the economy gets the cash that the Fed used for the purchase and the money supply increases. When it sells bonds, it takes in money as payment and the money supply decreases. How the quantity of money influences the price level and the inflation rate. The money supply of a country is a major contributor to whether inflation occurs. As a government evaluates economic conditions, price stability goals, and public unemployment, it enacts specific monetary and fiscal policies to promote the long-term well-being of its citizens. These monetary and fiscal policies may change the money supply, and changes to the money supply may cause inflation. Inflation can happen if the money supply grows faster than the economic output under otherwise normal economic circumstances. This is too much money chasing too few goods. During COVID, the government added another $1.9 trillion stimulus package on top of previous spending. This put too much money in the economy at a time when supply chain issues made the supply of goods low. This contributed to the inflation reaching 40-year highs. Inflation, or the rate at which the average price of goods or services increases over time, can also be affected by factors beyond the money supply. 1. Inflation occurs when the money supply of a country grows more rapidly than the economic output of a country. 2. The Federal Reserve changes the money supply by buying short-term securities from banks, injecting capital into the economy. 3. The quantity theory believes that the value of money and the resulting inflation is caused by the supply and demand of the currency. 4. There are situations where increases in the money supply do not cause inflation, and other economic conditions like hyperinflation or deflation may occur instead. 5. During COVID-19, the Federal Reserve materially increased the nation's money supply. As a result, the nation experienced higher than usual inflation. When the Fed increases the money supply faster than the economy is growing, inflation occurs. In this situation, the increase in money circulating in an economy is higher than the increase in goods produced. There is now more money chasing not as many goods in this economy. A decrease in the federal funds rate leads to an increase in the quantity of money, a fall in the exchange rate, and an increase in exports. When the Federal Reserve increases the money supply, inflation may occur. More often than not, if the Fed is attempting to stimulate the economy by growing the money supply, prices will increase, the cost of goods will be unstable, and inflation will likely occur. The Federal Reserve monetary policy goals of maximum employment means keeping the unemployment rate close to the natural unemployment rate. High employment means more dollars in the economy. Lower employment means less. The most direct problem with unemployment is that it results in a loss of human capital. How the exchange rate is determined. A floating exchange rate is where the currency price of a nation is set by the foreign exchange, Forex. It is based on supply and demand relative to other currencies. This is in contrast to a fixed exchange rate, in which the government entirely or predominantly determines the rate. Floating versus fixed exchange rates. Currency prices can be determined in two ways, a floating rate or a fixed rate. As mentioned above, the floating rate is usually determined by the open market through supply and demand. Therefore, if the demand for the currency is high, the value will increase. If demand is low, this will drive that currency price lower. A fixed or pegged rate is determined by the government through the central bank. The rate is set against another major world currency, such as the US dollar, euro, or yen. To maintain its exchange rate, the government will buy and sell its own currency against the currency to which it is pegged. Some countries that choose to peg their currencies to the US dollar include China and Saudi Arabia. Interest rate parity and purchasing power parity. Interest rate parity, IRP, is a theory according to which the interest rate differential between two countries is equal to the differential between the forward exchange rate and the spot exchange rate. 1. Interest rate parity is the fundamental equation that governs the relationship between interest rates and currency exchange rates. 2. The basic premise of interest rate parity is that hedged returns from investing in different currencies should be the same regardless of their interest rates. 3. Parity is used by forex traders to find arbitrage opportunities. Interest rate parity, IRP, plays an essential role in foreign exchange markets by connecting interest rates, spot exchange rates, and foreign exchange rates. IRP is the concept of no arbitrage in the foreign exchange markets, the simultaneous purchase and sale of an asset to profit from a difference in the price. Investors cannot lock in the current exchange rate for one currency for a lower price and then purchase another currency from a country offering a higher interest rate. Arbitrage is defined as the simultaneous purchase and sale of the same asset in different markets in order to profit from tiny differences in the asset's listed price. In the foreign exchange world, arbitrage trading involves the buying and selling of different currency pairs to exploit any pricing inefficiencies. Forward exchange rates for currencies are exchange rates at a future point in time, as opposed to spot exchange rates, which are the current rates. Forward rates are available from banks and currency dealers for periods ranging from less than a week to as far out as 5 years and more. The difference between the forward rate and the spot rate is known as swap points. If this difference, forward rate minus spot rate, is positive, it is known as a forward premium. A negative difference is termed a forward discount. Purchasing power parity. According to this concept, two currencies are in equilibrium, known as the currencies being at par, when a basket of goods is priced the same in both countries, taking into account the exchange rates. Purchasing power parity, PPP, is a popular metric used by macroeconomic analysts that compares different countries' currencies through a basket of goods approach. PPP allows for economists to compare economic productivity and standards of living between countries. Some countries adjust their gross domestic product, GDP, figures to reflect PPP. Balance of payments accounts and explain what causes an international deficit. The balance of payments, BOP, is the method countries use to monitor all international monetary transactions at a specific period. Usually, the BOP is calculated every quarter and every calendar year. All trades conducted by both the private and public sectors are accounted for in the BOP to determine how much money is going in and out of a country. If a country has received money, this is known as a credit, and if a country has paid or given money, the transaction is counted as a debit. Theoretically, the BOP should be zero, meaning that assets, credits, and liabilities, debits, should balance, but in practice, this is rarely the case. Thus, the BOP can tell the observer if a country has a deficit or a surplus and from which part of the economy the discrepancies are stemming.